crisis management and resolution in public debt.
Each one of us would each pay an equal amount, and we'd pay it off.
That bubble burst, it hit home to probably 40%.
Problem, i.e. they have way too much debt, not a liquidity problem, which is they can't just finance it.
Financial stability and crisis management. 1. Navigating financial storms. Financial and economic safeguards. Early warning systems and risk assessments serve as crucial guides in the financial world, like lighthouses steering economies away from danger. These systems, built on data analytics, economic indicators, and sophisticated algorithms, help us foresee financial turmoil and prepare for it. Financial ecosystem dynamics. Our financial ecosystem resembles a vast ocean filled with waves of market volatility, fiscal policies, and geopolitical tensions. Navigating this complex environment requires powerful tools capable of identifying future risks and assessing their impact. The role of early warning systems. Early warning systems function as high-tech binoculars, monitoring fluctuations in currency values, stock markets, and even early signs of debt crises. They provide crucial alerts for policymakers, investors, and the public. The importance of risk assessment. Risk assessment acts as our compass, evaluating the severity and impact of risks. This process blends quantitative analysis with qualitative insights to guide economies through challenges. Synergy for stability. The combined efforts of early warning systems and risk assessment showcase human ingenuity. Together, they allow economies to implement proactive measures, building resilience and enabling swift recovery from potential crises. 2. Negotiating debt restructuring, strategies and challenges. Debt restructuring basics. Debt restructuring resembles navigating dense fog. It's a path that requires wisdom, compromise, and a balanced approach. The goal: to help nations and entities struggling with debt find a sustainable way forward. Seeking common ground. In debt restructuring, creditors and debtors work toward mutual understanding. Creditors aim to recover funds without pushing debtors to insolvency, while debtors focus on securing terms that support long-term economic health. Strategies in negotiations. Transparency and flexibility are key to successful negotiations. Debtors often propose credible plans for economic recovery, while creditors may agree to extend repayment periods, lower interest rates, or engage in debt-for-equity swaps. Challenges to overcome political pressures, national pride, and diverse creditor interests can complicate restructuring. Additionally, new forms of borrowing add layers of complexity that require innovative approaches. International support. The global community often plays a critical role, offering technical assistance and mediation to facilitate fair and productive negotiations, contributing to long-term stability and growth. 3. The role of legal frameworks in crisis resolution. Legal foundations in crisis. Legal frameworks serve as the foundation for crisis resolution, providing structure and setting clear expectations. They offer a balanced approach to crisis management, ensuring fairness and transparency. Debt restructuring pathways. Legal frameworks outline procedures for debt restructuring, allowing borrowers and lenders to renegotiate terms in response to new economic realities. This can include options such as extended repayments or interest rate reductions. Insolvency and bankruptcy laws. These laws provide companies a chance to reorganize and continue operations, protecting employees and stakeholders while maintaining economic stability. Financial market regulations. Robust regulatory environments prevent panic during crises, promote transparency, and hold stakeholders accountable, ensuring that decisions are made responsibly. Adaptability of legal systems. Effective legal frameworks require swift enforcement and adaptability, allowing economies to respond to emerging threats and challenges effectively. 4. Bailouts versus bail-ins. Mechanisms and implications. Bailouts as a rescue mechanism. Bailouts involve external support for struggling institutions or countries, typically through government funds. The idea is to prevent broader economic collapse by providing immediate financial relief. Moral hazard concerns. Bailouts raise concerns about moral hazard, as entities may take on more risks, knowing a safety net exists. This raises questions about governance and the long-term health of financial systems. Potential challenges of bail-ins. Bail-ins can lead to a crisis of confidence, as investors may rush to withdraw funds to avoid losses, highlighting the need for clear, predictable bail-in mechanisms. 5. Case studies. Successful crisis management examples. Japan's lost decade. After the 1990s asset bubble burst, Japan's recovery involved monetary easing, fiscal stimulus, and structural reforms. Japan's experience emphasizes the value of unconventional solutions during prolonged economic challenges. The Nordic banking crisis. Sweden and Finland addressed their crisis through transparency and government intervention. They nationalized troubled banks and restored public confidence, highlighting the importance of decisive government action. Chile's debt crisis response. Chile implemented economic reforms, such as trade liberalization and fiscal discipline, to recover from its 1980s debt crisis. Common success factors. Each case showcases bold decision-making, adaptability, and a focus on long-term stability. These qualities are essential for overcoming financial crises. Lessons for today. These success stories remind us that resilience, innovation, and experience-driven policies are key to navigating and recovering from economic challenges. 6. Building resilience. Policy measures. Post-crisis. Regulatory reforms. Post-crisis, regulatory reforms strengthen financial oversight, such as capital requirements for banks and rules for non-banking entities, creating a robust foundation for future stability. Fiscal consolidation governments work to restore budget health through spending cuts and tax reforms, balancing short-term recovery needs with long-term sustainability.